Silver at $79, from industrial metal to strategic asset in a fracturing global economy. The financial landscape of late December 2025 has been defined not by the festive calm that usually descends upon Wall Street, but by a seismic realignment of global asset hierarchies that has left institutional observers stunned. As trading desks thinned out for the holiday season, a phenomenon observers are calling the holiday paradox took hold, where low liquidity collided with a violent scramble for physical assets, propelling silver into a position of economic dominance that few traditional analysts had forecasted. By the close of the year, silver had officially surpassed the market capitalizations of technology behemoths like Apple, Microsoft, and Alphabet, securing its place as the third largest asset on Earth with a valuation exceeding $4.48 trillion, trailing only gold and the semiconductor giant Nvidia. This is not merely a price rally. It is a structural repricing of a strategic material that has found itself at the nexus of geopolitical warfare and an insatiable industrial revolution. To understand the magnitude of this shift, one must look beyond the ticker tape and into the mechanics of the vaults and supply chains that underpin the global economy. The catalyst for this explosive move, which saw silver prices breach $79 per ounce and year-to-date gains exceeding 169%, was a convergence of regulatory traps and physical shortages that began to close around the market in the final quarter of the year. The narrative that silver is merely a volatile cousin to gold or a simple industrial input has been shattered by the realization that it has become a weapon of economic statecraft. Central to this geopolitical reshaping is the aggressive maneuvering by major sovereign powers to secure critical mineral supplies. In what market insiders have described as a resource blockade, China, the world's dominant refiner of silver, announced export restrictions effective January 1, 2026. These new quotas and licensing requirements are designed to ring-fence silver supply for domestic solar, military, and artificial intelligence applications, effectively cutting off a vital artery of supply to the Western world right as demand is peaking. This move was compounded by a simultaneous regulatory change at the London Bullion Market Association, which banned silver bars bearing non-Roman lettering from its good delivery lists starting the same day. This technical rule change effectively rendered vast stockpiles of Russian and Asian silver illiquid in Western markets, creating a bifurcated global market where accessible metal became scarce overnight. The immediate consequence of these geopolitical strategies was a total breakdown in the arbitrage mechanisms that usually keep global prices aligned. For decades, if silver was more expensive in Shanghai than in New York or London, traders would buy in the West, ship the metal east, and pocket the difference, bringing prices back into equilibrium. By December 2025, however, this arbitrage bridge had collapsed. A premium of nearly $7 emerged between the Shanghai Gold Exchange and the COMEX in New York, a gap that persisted and widened because Western vaults were too depleted to ship metal fast enough to close it. The inability of the market to flatten this price discrepancy signaled a terrifying reality to bullion banks. The paper market, dominated by futures contracts and derivatives, had decoupled from the physical reality of available metal. This decoupling was driven by an industrial hunger that has proven to be entirely inelastic. Unlike jewelry buyers who might balk at high prices, the industrial consumers driving this rally, specifically in the solar, electric vehicle, and artificial intelligence sectors, cannot afford to stop buying. A factory manager overseeing a $50 million solar panel production line cannot halt operations because silver has jumped from $30 to $70 an ounce. The cost of shutting down is far higher than the premium paid for the metal. This dynamic was exacerbated by the technological shift in photovoltaics toward high-efficiency TOPCon and HJT cells, which require up to 50% more silver than previous generations. With the solar industry alone consuming over 200 million ounces annually, roughly 20% of global supply, the demand floor beneath the silver price has become concrete. Furthermore, the explosion of the artificial intelligence sector has added a new critical layer of consumption. AI data centers and the high-performance chips powering them, such as those produced by Nvidia, rely on silver for its unrivaled electrical and thermal conductivity, While some analysts speculated that efficiency breakthroughs, such as those claimed by the Chinese startup DeepSeek, might reduce hardware needs, the prevailing market logic follows the Jevons paradox. As efficiency lowers the cost of AI compute, the total demand for the infrastructure explodes, thereby increasing the aggregate consumption of silver. This technological imperative has transformed silver from a commodity into a strategic mineral, a classification formally adopted by the U.S. government, which now views silver stockpiles as a matter of national security. The pressure on physical supplies has been compounded by a phenomenon known as the Great Rotation in global finance. Institutional capital wary of U.S. fiscal instability and the looming threat of sovereign debt crises began a massive pivot away from fiat-denominated assets and overextended equity markets into hard assets. This trend was accelerated by the de-dollarization trade, where central banks, led by the BRICS Plus alliance, aggressively accumulated precious metals to insulate their reserves from sanctions and currency debasement. India, in particular, acted as a black hole for silver, importing staggering quantities, over 1,700 tons in October alone, and formalizing silver as eligible collateral for bank loans, a move that unleashed tidal waves of domestic hoarding. As these macro forces collided, the internal mechanics of the silver market began to flash warning signs of a systemic failure. Lease rates, the cost to borrow physical silver, spiked to annualized levels ranging from 39% to 200%, a clear indication that holders of the metal were unwilling to part with it at any price. This backwardation, where immediate delivery costs significantly more than future contracts, is the hallmark of a physical shortage. Rumors began to circulate through trading desks of a massive, emergency lease, involving J.P. Morgan Chase, allegedly requiring the return of 4,000 tons of silver to a Chinese counterparty by early January 2026. While unconfirmed, the mere possibility of such a liability in a market draining 60% of its registered inventory in a single week sent shorts scrambling for cover, fueling a parabolic rise in price. The sheer velocity of the price move in December 2025 created a feedback loop of panic and accumulation. As silver broke through psychological barriers at $50, then $60, and finally $70, it triggered a vault drain at the COMEX, with registered inventories plummeting to critical levels. The ratio of paper claims to physical ounces is estimated to be as high as 9-to-1, meaning that for every owner who stands for delivery, there are 8 others holding paper promises that cannot be fulfilled. This fragility was exposed during the holiday period, when thin liquidity allowed prices to gap higher on relatively small buy orders, creating a volatile environment where the market began to price in the risk of exchange defaults or force majeure declarations. It is important to recognize that this is not a sudden, temporary blip, but the culmination of a structural deficit entering its 5th consecutive year. The world has been consuming more silver than it produces since 2021, with cumulative deficits exceeding 800 million ounces. Mine production has remained stagnant at roughly 830 million ounces, constrained by the geological reality that most silver is mined as a byproduct of copper, lead, and zinc. This inelasticity of supply means that higher silver prices do not immediately translate into more metal coming out of the ground. A copper miner will not ramp up production just to get more silver if the copper market is soft, leaving the silver market without a supply response mechanism to dampen the price surge. The economic consequences of this revaluation are starkly creating winners and losers across the corporate landscape. Primary silver miners and streaming companies have seen their valuations triple, leveraging the rising spot price against relatively fixed costs to generate record free cash flows. Conversely, industries reliant on silver as an input, particularly in the solar and electronics sectors, are facing severe margin compression. The threat of thrifting, engineering products to use less silver, looms large, but technical limitations mean that significant substitution is years away, leaving manufacturers exposed to the current squeeze. As the world looks toward 2026, the silver market stands at a precipice. Retail investors and some analysts are already eyeing triple-digit prices, predicting that the momentum will carry silver past $100 per ounce as the physical squeeze intensifies. However, major financial institutions remain more conservative, warning that such parabolic moves often invite sharp corrections and that high prices could eventually destroy demand. Yet the fundamental drivers, geopolitical fracturing, the green energy transition, and the loss of confidence in fiat currency, suggest that the era of cheap silver has definitively ended. The white metal has emerged from the shadow of gold, not just as a store of value, but as an indispensable component of the future economy, commanding a valuation that reflects its new status as a strategic global asset. The situation developing in the silver market is a textbook example of what happens when a finite, indispensable resource encounters an infinite demand for growth and security. The holiday paradox of 2025 served as the wake-up call, revealing that while the paper markets of Wall Street may freeze, the physical hunger of the global industrial machine does not sleep. As export bans take hold and vaults run dry, the price of silver is no longer just a number on a screen. It is a measurement of the world's desperation to secure the building blocks of the next technological age. The implications of this shift extend far beyond the commodities pits. The rise of silver to a market capitalization rivaling the world's largest tech companies signals a broader rotation in the global economy, a shift from the intangible to the tangible. For years, value was defined by user bases, software ecosystems, and brand equity. Now, value is increasingly defined by physical possession, supply chain security, and the raw materials required to power civilization. The great rotation out of financial assets and into materials is a defensive posture against a world that is becoming more fragmented, more protectionist, and more reliant on hard assets to anchor economic stability. This transformation is perhaps most visible in the behavior of sovereign nations. The accumulation of silver by countries like Russia, which initiated a multi-year plan to build strategic reserves, and India, which saw record imports, underscores a loss of faith in the U.S. dollar as the sole arbiter of value. By pivoting to precious metals, these nations are insulating themselves from the weaponization of the dollar and the potential for sanctions. This de-dollarization trade provides a sustained bid for silver that exists independently of industrial cycles, creating a dual-engine market where both factories and central banks are competing for the same shrinking pool of bars. The technical picture mirrors this fundamental strength. The breakout above the long-standing resistance levels of the past decade has pushed silver into price discovery mode, a phase where the market attempts to find a new equilibrium in uncharted territory. While technical indicators like the Relative Strength Index, RSI, suggest the metal is overbought in the short term, the underlying market structure, characterized by steep backwardation and high lease rates, suggests that any pullbacks will be shallow and aggressively bought by industrial users desperate to secure inventory. The volatility witnessed in late December, with prices swinging wildly in thin trading, is symptomatic of a market where liquidity is drying up and sellers are effectively going on strike, waiting for higher prices. Furthermore, the rumors surrounding the short positions of major bullion banks add a layer of systemic risk that cannot be ignored. If institutions like J.P. Morgan are indeed scrambling to cover massive lease obligations in a market with no liquidity, the potential for a short squeeze of historic proportions remains high. This scenario would see the price of silver disconnect completely from traditional valuation models, driven instead by the panicked buying of entities facing default. The silver bomb, as some analysts have termed it, represents a ticking liability for the paper market that could force a total restructuring of how precious metals are priced and traded. Looking ahead, the first quarter of 2026 will be the proving ground for this new reality. The implementation of China's export controls on January 1st will be the first major test. If Chinese supply effectively vanishes from the international market, the premiums in London and New York could explode, forcing a rationing of demand that would send shockwaves through the solar and electronics industries. At the same time, the Federal Reserve's monetary policy will play a crucial role. With markets pricing in further rate cuts, the opportunity cost of holding silver will continue to fall, adding fuel to the investment fire. The divergence between the retail and institutional outlooks also highlights the confusion of the moment. While retail investors, driven by the narrative of a squeeze, are targeting $100 and beyond, institutional banks are issuing cautious forecasts, predicting a reversion to the mean. This disconnect often precedes major market shifts, as institutional models struggle to account for paradigm changes like the weaponization of supply chains or the collapse of arbitrage. If the retail and industrial view proves correct, the banking sector may find itself on the wrong side of the trade, forced to chase the market higher to hedge their exposure. Ultimately, the story of silver in 2025 is the story of a world realizing that it has built a digital future on a foundation of physical scarcity. The metal that was once disregarded as poor man's gold has been revealed as the critical linchpin of the green and digital transitions. Its surge to become the world's third-largest asset is a recognition of this indispensability. Whether it reaches triple digits in 2026 or consolidates its massive gains, silver has fundamentally changed. It is no longer just a trading vehicle. It is a strategic imperative, a geopolitical weapon, and a financial lifeboat in a stormy global economy. The revaluation of silver is not just a market event. It is a signal that the era of easy resource availability is over, and the race to secure the materials of the future has truly begun. The holiday paradox will likely be remembered as the turning point, the moment when the facade of infinite paper liquidity cracked, revealing the finite reality of the physical world. As vaults drain and nations hoard, the price of silver has become a barometer for the health of the global supply chain and the stability of the fiat monetary system. For investors, manufacturers, and governments alike, the message is clear. The rules have changed, and in this new era, he who holds the metal makes the rules. The unprecedented rise of silver is a testament to the enduring value of tangible assets in an increasingly intangible world. A reminder that when the chips are down, nothing replaces the security of what you can hold in your hand.